The following program sponsored by Adams Financial Concepts.
About money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth, and has a proven track record of managing long-term investments surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
It's Friday, and we're going to be talking about money. Kristen Hanna wrote a book called The Nightingale. It's a fictional account about helping Jews escape the Nazis during the occupation of France. And there's one line in that book that I really, really liked. It's called, and I quote, "If I have learned anything in this long life of mine, it is this. In love, we find out who we want to be. In war, we find out who we are." You know, I read that and I thought, you could make a corollary or something similar to the stock market, and it seems so appropriate this week and what's going on in this month and last month of what's going on. So I adapted it to say this. In my over 30 years in the investment business, I have learned this. In the good times, we find out what our hopes and our dreams and believe we will realize them. In down markets, we find out who we really are. I think it's one of those times we're going through. And today's program, there is so much information I wanted to cover, and I can't get it all. It's going to have to come, some this week, some next week. There is a theme going through this whole thing that I've been talking about with what we're seeing now are symptoms of an issue, of a credit bubble bursting. And we're seeing all these symptoms. But I want to deal with some of these symptoms because they're not going to be short-lived. Some are going to be a couple years. But there's another thing that I believe is happening. A few months ago, I talked about the kids market. Over 50% of mutual fund managers are under the age of 30. It's one thing to read about the Great Depression. It's one thing to read about the Great Recession. But these kids, and they are kids, they think they're adults. But they were in high school. They were in college when the Great Recession happened. They did not experience 2008, 2009 like many of us did. They didn't have good friends who lost their jobs, who were very qualified and still couldn't find a job after a year or 2 years. They didn't have friends who were foreclosed out of their house. They didn't have friends who went through that whole process. And the worry that people were going to lose their job, it was a terrifying experience for a lot of people. They didn't go through that. You can read about it, but you don't really feel the emotion that's behind it. And I think that's what's happening today. Part of that is they're experiencing, for the first time, a really down, unexplainable market. And they're feeling the emotions for the first time. When you go through this the first time, and when you're managing money, it's a terrifying experience. I've been through it. Not a few times. I've been through it, sometimes what seemed too many times. But having been through it, you can sit back and realize what's really happening. When you're going through it the first time, it is terrifying. It is terrifying. And especially as you listen to the news and you see the number of pessimists. My first time going through it was in 1989, October 19th, 1987, when the market plunged 508 points, 30% lost in one day. And it was terrifying to sit there and watch and know that people had lost money. People that were my clients had lost money. It was a tough time. And yet, looking at all that, because I was a little bit older, had some basis of understanding. And when a mutual fund wholesaler came into the office, as they do, they come in to pitch their product, and he said, we've lost $1 trillion out of the economy. You're going to be able to walk into Nordstrom and hear a pin drop. I went back to home, told my wife what the guy said. I said, we have to go to Nordstrom. This guy said we'll be able to walk into Nordstrom because these people have lost $1 trillion. We'll be able to hear a pin drop. It'll be so empty. Well, we went on that Saturday. We could hardly get into this store. And all I could think of is somebody didn't tell these people they lost $1 trillion. But I began to count the number of times people said the market and the economy were going to turn out poorly, and the number of times people were optimistic, that were on the optimistic scale. And at 60-1, 60 pessimistic outviews and 1 positive outview, I quit counting. I don't know what the total was. That was people on TV and in the newspapers. It was a time when people were so pessimistic. And listening to the news today, I see a lot of the same things. It seems that you hear people talking about things are going to be as bad as 2008. They may be even worse than 2008. But there are those who think there are going to be good things as well. I'm in that latter group. I believe that we're going through a time which is going to work itself through, and we're going to be having a very good year in 2016. Could be wrong. I've been wrong before. But I believe that there's a good chance that we're going to be positive this year. So the market right now is trading in lockstep almost with oil prices. In the past, when oil price increased, the U.S. stock market would increase. Well, in the past, oil prices and the stock market were related because when oil prices were increasing, the economies were increasing. And when prices dropped, the stock market dropped. If you remember back to 1973, when OPEC did the oil embargo, there was a shortage of oil, and prices of oil jumped. Inflation took off, and it caused a lot of economic havoc. In 1986, we had an oil glut, and the price of oil slumped off to $10 a barrel. And economies were really sluggish at that time. But because of the low price of oil, economies really took off and grew in that period of 86 onward. So right now, what do we have? We have oil prices that are down 75%. If you look at where we are, we're in economics 101. Basic economics. If you remember economics class, supply and demand are determinant of price. If you've got a lack of supply and demand going up, price goes up. If you've got an excess supply and demand going down, prices go down. That's where things are. You know, we have the soothsayers, the market strategists, who are trying to predict what's going on. I mentioned this before, and I'll mention it again. Jason Zweig wrote a book called The Devil's Financial Dictionary, and I picked up one of his definitions, which I really like a lot, and I think it applies today. He called a market strategist. It's a noun, and I'm quoting, a direct intellectual descendant of the ancient Roman official known as the haruspes. That official was practiced in the Etruscan art of divining the future by inspecting the livers of sacrificial sheep and chickens. The typical market strategist uses methods similar to those of a haruspes, but less accurate. However, the modern market strategist has much higher social status and earns vastly more greater income than a haruspes, even adjusting for more than 2,000 years of inflation. You know, we're living in a time when I believe the pessimists are going to be wrong. They're going to read the tea leaves. They're going to read the chicken livers and the goat livers and the sacrificial sheep, and they're coming up with what they see, and I believe it's going to be wrong. It's a matter of supply and demand. And what the pessimists are seeing, looking at it from their side, seeing what they're seeing, is that they're looking at oil prices drop. In the past, you had a constant supply, and when prices of oil began to drop, it indicated that the economy, the world economy, or a country's economy, was really falling off and slowing down. What they saw was a drop-off in demand, not a change in supply, but a drop-off in demand. You know, that's what they saw. And they hear China is slowing down. You know, other countries. The world is slowing down. Growth is slowing down. The International Monetary Fund has reduced their growth rate. It's slowing down. But think about China. China's slowing down. Their growth rate is going to be, or was, slowed down. It was only 6.9% in 2015 versus 7.3% in 2014. That's a slowdown. But it means that the economy grew. It didn't tumble down into a recession. Slowing growth does not necessarily mean negative growth. In fact, if you look at China's oil consumption in the fourth quarter of last year, it was a record high. If there was a recession going on, they would be reducing their oil consumption. If you look at Europe and Japan, they're also seeing growth and increased demand for oil, not reduced demand. If you look at where we are, world oil consumption is rising, but not as fast as supply. We're going to come to a commercial break, and I want to pick this up after commercial break. You want to hear what the rest of the story is, I hope. So stay with us, and we've got a great guest, and we'll get to some of these other things as well. Don't go away.
About Money with Mike Adams will resume in a moment on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Lots of people manage investment portfolios. Just a few can manage a successful portfolio and provide exceedingly great service to their clients. Here's Mike Adams from Adams Financial Concepts.
We believe the price you pay should be based on the performance of your portfolio and the quality of service you receive.
Mike, it seems that a lot of companies subscribe to the one-size-fits-all mentality of investing. Does one size really fit all?
Not with us. Every portfolio that we manage is customized to fit each particular client's objectives and risk tolerance. We place our client's interests first in all portfolio decisions.
If you're looking for a home for your seven-figure plus investment portfolio, call Mike Adams of Adams Financial Concepts, specializing in creating and maintaining wealth for over 20 years. 206-903-1019. That's 206-903-1019. Or log on to adamsfinancialconcepts.com.
Now we return to About Money. There's more information waiting for you at adamsfinancialconcepts.com. Here again is your host, Mike Adams.
So I've been talking about oil and what's going on in oil. Down again today, down 8% for the week. You heard the information coming through. The pessimists look at that and say the world economy is slowing down, but that's not what's happening at all. We have an oversupply of oil. And if you look at supply and demand, we had in 2010, the world was consuming 88.2 million barrels of oil a day. 88 million, just over 88 million in 2010. In 2015, we were consuming 94.5 billion barrels of oil, increasing about 1 to 1.25 million barrels per day every year. Fairly consistent if you look at it. 2013 was 91, 2014 92, 2015 94. Consistently moving up. That shows the growth of world GDP because as economies grow, they consume more energy. But the demand was increasing, but not increasing as fast as supply. So that's one of the things the pessimists look at, is that there's an excess of oil capacity and prices coming down. They don't look at the supply, really. They're just looking at the price. They also look at the Purchase Managers Index. Why? Because the Purchasing Managers Index is a leading indicator. When companies are gearing up, the first thing they do, they have to order materials in. So as they order materials in, that goes to the purchasing managers, and the Purchasing Managers Index is a very good indication of what's going on in manufacturing and in service industries. But if you look, right now, manufacturing is contracting. Listen to that. Normally, if an economy is doing poorly, manufacturing does contract. Why is it contracting? Because energy companies, mining companies, material companies are all struggling with low commodity prices. Earnings are estimated to be down 5% for the Standard & Poor's 500 for the year, but a good portion of that is energy companies and commodities. Usually, there's a rule of thumb about oil prices. For every 10% drop in the price of oil, it adds 0.1 to 0.5% to GDP growth. So we've experienced between a 70 and 75% drop in the price of oil, from 110 down to 30. That should add 3/4 to almost 4% to GDP growth, because lower oil prices mean that consumers have more money in their pocket, and most of those consumers are going to spend that. They're going to buy things. There's been a concern about that because it's not showing up in consumption figures. One reason why it's not showing up in consumption figures is part of consumption figures are calculated on the price of gasoline, parts priced on commodity prices. Those are things that are going down. They're positive, but they show up as negative consumption for consumers. You know, there was an interview a little over a week ago by Jamie Dimon, the CEO of JP Morgan Chase, and he said they're not relying on surveys. They can actually see, because of their customer accounts, what people are buying. And yes, they're saving a little bit. Yes, they're paying down some debt, but they're also buying. They're seeing, from the bank standpoint, they're seeing people going out and buying, and they're buying large items. Think about it. We're setting records on automobile, car sales. That's because people have more money in their pocket, and they're buying bigger units. What's the fastest selling thing? SUVs and trucks. What about SUVs and trucks? They consume more gasoline. More gasoline, when things are cheaper, it's basic economics. But there's an issue, and there's a concern, because emerging countries, emerging markets, their stock markets are going down. And think about it. A lot of those emerging countries are commodity or oil dependent. If you look at emerging countries, they have $650 billion worth of debt. And a very large portion of that is related to oil and commodities. There's going to be defaults, sovereign defaults, because of that. Venezuela already with 140% inflation because oil trades in dollars and because prices have come down. Venezuela has declared an economic state of emergency. Mexico and Colombia are raising interest rates. And the estimate is that Russia will run out of reserve currency by the end of 2016. If you look at part of that, what happens when countries are reducing their currency, they're selling bonds and they're selling stocks. Bonds and stocks. What does that do to our market? Yes, they are selling our stocks. You know, what happened is we had a lot of what seemed to be demand back in the 2000, end of 1990s, the beginning of the 2000s. You had a huge number of futures contracts. You had this whole concept of commodities hedge funds, commodity mutual funds. You had financial advisors that said commodities were another asset class. And when you do an asset allocation, which you know I don't believe in if you've listened to the program, if you do an asset allocation, then you need to have commodities in your portfolio. You need to have emerging markets. I don't do either of those. But it gave the appearance of having extra demand, a demand that really wasn't there, because in 2008, when we hit oil prices of $157 a barrel, they had ships at sea waiting to deliver oil, but the people that had contracts for that oil had no intention of ever taking delivery of that oil. They had every intention of benefiting from price increase, and that's what they were doing, is rolling from contract to contract until there's no buyers of that contract. And then the price came tumbling down. There was a concern of peak oil, that we were going to run out of oil and oil pricing was going to continue to rise. It was a limited supply. It led to a frenzy in oil, led to a frenzy of investors wanting to invest in oil. There was an expense. We spent $6 trillion to drill for oil in the Australian outback, offshore in Brazil, and North Dakota. North Dakota, there's a town, and I really wanted to look up and find the name. I can't find it. It was a town of 160 or 170 people that built 1,300 new houses to keep the population there, the oil drillers. I don't know that they'll ever sell those 1,300 homes, but North Dakota had extraordinary growth because of the oil. All the billions and trillions that went in to those areas. That was a whole lot of excess supply. And you know what? It's out there. Fracking went from 5 million barrels per day in 2008 to 9 billion barrels per day in 2015. 2015, we were producing 96.3 million barrels of oil, but consuming 94.5. That's up almost 1.2 million barrels per day over 14, up 2.5 over 2013, but in excess of what's consumed. There's 1.8 million barrels of oil storage in the world, and that's filling very fast. The next thing is to store oil on ships, and then we're going to run out of storage capacity. If we're growing at 1.2 billion barrels a day, in a couple of years, oil capacity will be taken up and supply will meet demand, and you'll have this extra storage to work off. But it's going to be 2017 or 2018 before demand catches up to supply. You know, you hear that lower price will force companies out and the lower the better. I don't think so. I think that it's going to have no effect in slowing down production. And I'm going to tell you why later in the program. But before we get there, I want to take some time and introduce my guest. I want to keep you wondering what happens with the oil price down. We're coming up, and I want to introduce my guest today. My guest is the new owner of Silver Fox, Scott Carman. Welcome to the program, Scott.
Thank you, Mike. It's a pleasure.
We're going to have just a couple minutes to get started, but why don't we start with your background?
My background. I started out coming out of art school, having dropped out of business school and failed at public speaking, and really wanting no part of the business world, and then kind of stumbled upon presentation design, and here I am now owning I also dropped out of graphic design school, I might add. And now here I am happily being the owner of a business that is specialized in graphic design, especially in relationship to public speaking.
You know, dropping out is not a big deal. When you hear all the people who started businesses and stopped, I mean, the guy who started Hershey's had 3 or 4 candy companies before. I remember, and we'll get back to your story, but I remember the story about, what's his name, who plays the piano. Maybe we'll have to come back to that after, not Liberace. He's a funny guy. Anyway, terrible thing. I should remember, but he talks about his dad started a beverage company called 1UP, and that failed. So he started 2UP, and that failed. And then he started 3UP, and that failed, and 4 and 5 and 6UP. And then he gave up after forming 6UP anyway. I'll remember the name during the break, and we are coming to a break. Stay with us while we get through this break, and you can text and let us know. Twitter, send us a tweet. Let us know what the name of that person is. We'll see.
Open House with Team Open House.
Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
4. About Money continues. Remember the website adamsfinancialconcepts.com. Here's Mike.
So I'm here talking to Scott Carman, the CEO and owner of Silver Fox. Let's talk about Silver Fox and what Silver Fox does.
Yeah, we're a very niche creative services firm that has the pleasure of being able to meet and work with some of the top minds in the world, some of the top executives, some of the people that are endeavoring on some of the just fantastic work. We get to meet and work with them directly as they go out on stage and present their ideas and their thoughts to an audience, and we help them to craft their message. Most of them are not natural-born gifted speakers to be on stage, so we help coach them on how to deliver that message to that specific audience so that they can drive influence or make sure their ideas have the impact they're looking for, or that audience walks away with the action that they're looking for them to take.
So, you know, you hear a lot of presentations by CEOs of at their earnings call or when they have a shareholders meeting. Is that the sort of thing that is up your type of business?
Absolutely, yeah. There's a large variety, and definitely we support those types of events. Anything from a boardroom or a conference room to a conference center to venues that are the stadium venues, really. So you have sales meetings, trade show events, definitely shareholders. Some of the favorite work that we do is with the investment community, especially in Seattle, where we help get people looking for venture capital ready to present to potential investors, which that's a really fun type of project for us.
So tell us about one, or tell us about how you would prepare somebody to go out and make the pitch for money.
Well, it's really interesting because they are very close to what they've built. It's usually their, say you're a developer, a software developer, you're really close to your technology. And amongst your peers, it's really easy to talk about your technology that you've built. Now, when you're going in front of investors, to be able to interpret the value proposition, the problem that you're out there to solve, the market opportunity, to really convince them that this is a great opportunity for them, you've got to learn how to craft that narrative so that it can be, you create a compelling argument to win that money and move forward. And we've gotten pretty good at it. We've probably helped raise well over $200 million in investment capital for companies.
So when you look at, what comes to mind is Shark Tank, for example.
Yes.
Where you have people going before these guys and making their presentation. You must see some pretty awful presentations.
Yes, and that's really our job. We're pretty blunt with our consulting that we do. We don't want them to step in front of any audience with a horrible presentation. We want to be part of their success. And so when we see something that really needs to be done, something that's missing, something we know investors are going to ask, or any audience is going to ask of them that's missing, we're going to point that out to them and make sure they have that covered so that they can pass on, especially an investor presentation. So you get consensus and you move on to that due diligence period, which if you don't prepare well, you'll never get there.
I don't know if you watched the miniseries of the 2-night show on Madoff. The last night.
Did not.
There was a guy that was asked to actually reverse engineer because Madoff had been producing positive returns for every single quarter except for one quarter over a long period of time. Sophisticated investors should have known. But anyway, his boss came to him, the guy that owned the hedge fund, and said, we need to reverse engineer and figure out what he's doing. And he went through the whole thing and worked on it overnight and found that it was really a fraud. And then he called the SEC and got to present before the SEC. And obviously his presentation was horrible. They indicate some of it. I actually ordered the paper and read the paper, but anyway, that's neither here nor there. But if you look at what he did, he was so involved in the math and showing that it was impossible to achieve that the SEC didn't give any credence to his presentation at all. And that must happen. That's just one example that happened. You know,
Absolutely. We do see that quite a bit, and we really want to help coach people so that they can advance as speakers, so that they're very conscious about what they do when they go out on stage. And what we want to see is an audience walking away excited about what they just heard and really parroting what they just heard. And that's really a mark of success right there. Any speaker that goes out, say a CEO, needs to get their sales staff aligned for the year. And the success of their sales kickoff is right there. They need to successfully communicate to their managers and their VPs and the sales staff that's in attendance, because the results of this talk are going to show up in, say, Q3 sales results. Now, if they don't do a good job here getting alignment, people leave that event really unmotivated, uninspired, and with a lack of vision or direction of that company, and you're not going to see those results in Q3. So we see it as that important. This moment on stage is, there's a huge amount of gravity to that moment. We want people to realize that, embrace it, and utilize it to its full potential.
So in doing the presentation, how far do you go? Do you help them develop the slides? Do you help them and write in the talk that they're going to give?
We like to get right in there, and first we'll interview them with what their goals are, and we'll find out what their content, what they need to say, and then we'll work with them through a methodology of storyboarding, where we will map out their narrative and then help write their talk for them, and then we'll help them rehearse in advance. Then we'll take them on site, where typically there's some form of a stage. We help them learn how to move around the stage to use their physical presence. And then we also build their slides as well. We want the visuals only to be there to reinforce what is actually being said in a very compelling visual manner. And then during the show, we'll be backstage running the show as well. We'll be stage managing and helping the speaker get ready and push them out on stage and be there to catch them when they come off.
It must be something that's fun to do, and you get to see a large variety.
Absolutely. Yes. One of our favorite events is the TEDx Rainier event, where we've supported well over 100 speakers, anywhere from rain scientists to astronauts, people just doing great work out there. So we get to meet them and coach them through this whole process. These people are typically not naturally born. They're specialists in what they do, and they need a lot of help getting out on that stage, something that a lot of them have never done before. But so we get to meet them and get to know them really well. They become friends. Still in contact with a great number of them over the past 5 years, and we learn so much every day. Mm-hmm. In the morning we might be working in telecommunications, and the afternoon we're in big cloud data, and then we might be working in healthcare by the afternoon. It's fascinating. You really learn a lot.
So who was the appropriate audience or your appropriate customer base?
We really are looking for, we keep our eye out for people who have a healthy respect and a recognition of the importance of that moment on stage. Those people get it. They're people that really want to learn. We've seen some of the best speakers be actually the most insecure speakers because they actually really understand. They really want to drive and be better and better. These are really teachable people, and they have a healthy respect for what we're providing, and that really makes for a good client. And that can typically it's your executive speakers who understand this, and it really comes down to identifying that ideal client.
So tell us your ideal clients so listeners will know if they fit that class.
I really would say we would hope that everybody understands how important public speaking is to advancing your own career. So whether you are just starting off out of school or if you're a young manager, anywhere in the management level, all the way up to the top level, executive level, when you're talking to somebody, that's an opportunity to make an impression. Whether it's you're managing your team, it's a really important skill to develop, and it requires expert help to do it. Just like if you went to school to learn a certain skill, it's the same thing, and it's a worthwhile investment. It will help you move further faster. So we would love to help. Everybody would recognize that need, but we definitely have a core list of clients who we very much enjoy helping, and they really excel at communicating with the broader audience.
And it would seem, when you think about it, what seems clear to somebody that this is a key point may not be a clear point to the audience. It may not be a clear point to the people that you're really addressing. So you bring that perspective to what people are saying or what they're presenting.
Yes, and that's we definitely provide the objectivity when somebody comes to us and they're trying to explain what they want to say, and we'll come in and if we don't understand it, we really don't think their audience is going to understand it either, because we know their audience, and so we'll work with them until they really convince us that audience is going to understand, and they go through a long process, and in the end, they come out successful.
Don't go away. We'll be right back, and we'll find out how to get a hold of Scott. We'll also talk about what's the impact of this oil. What is it for investors? Don't go away. We'll be right back.
Lots of people manage investment portfolios. Just a few can manage a successful portfolio and provide exceedingly great service to their clients. Here's Mike Adams from Adams Financial Concepts.
We believe the price you pay should be based on the performance of your portfolio and the quality of service you receive.
You know, Mike, it seems that a lot of companies subscribe to the one-size-fits-all mentality of investing. Does one size really fit all?
Not with us. Every portfolio that we manage is customized to fit each particular client's objectives and risk tolerance. We place our client's interests first in all portfolio decisions.
If you're looking for a home for your 7-figure plus investment portfolio, call Mike Adams of Adams Financial Concepts, specializing in creating and maintaining wealth for over 20 years. 206-903-1019. That's 206-903-1019. Or log on to adamsfinancialconcepts.com.
We're back with more about money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
So I'm here with Scott Carman of Silver Fox, and before he leaves, I just want to let you, the listener, know how to contact him. If you see this is a valuable service, and I believe it is a valuable service for a lot of people, if you wanted to get a hold of Scott, how would they do that, Scott?
Well, you can definitely visit our website. It's www.silverfoxprod.com, and definitely welcome to call me directly, actually, at 206-336-0764. Any listeners out there, I'd love to speak with you and help you out.
That'd be great.
Excellent.
So do follow up on that. Do give him a call. It's well worth it, and the benefits are some of those intangible benefits which do, in fact, turn out to be positive. So I was talking about oil early in the program. I want to come back to that. I want to come back to the impact, where it's going to be, because I started by talking about market strategists, macroeconomists. Macroeconomists look at data from a mile high. They look at the total. They aggregate everything, they put it together, they throw it into a funnel, they run it out the end of the funnel, and they look at the totals. And the totals this time are going to be very, very misleading, because I believe you have two different things going on. You have commodities, you have oil, you have junk bonds, you have REITs, you have private equity, you have emerging markets. You have everything related to that aspect of the economies, the world economies, and those are suffering through. It's going to take a couple of years to work that through. And it's not going to be a matter of price going down for everything. There are going to be a few things where even with a low price, it's not going to put a lot of people out of business. But they're going to look at the total. Market strategists and index funds are looking at a total, and part of that total is going to do well, and part of it is going to really suck, to put it in the real terms. Simon Flowers, who is with Woods Mackenzie and industry consultants, says at $30 a barrel, 94% of global production covers the operating cost. Now, when you think about what the break-even point is, and I would talk to people at conferences, because at conferences you have exhibitors, and at those exhibitors they're trying to get financial advisors to go out to their clients and get them to invest in oil exploration, oil-producing properties, natural gas. I never did any of those. But I would talk to the people and ask them where your break-even was, and it was at 75 or 95 bucks a barrel. But that is recovering the money that they borrowed, the money for their equipment. But when it comes down to operating costs, just what you have to pay workers, their salaries, for the office supplies, for the tools and so on, not the big equipment, but the day-to-day operating cost, $30 will cover it for 94% of those who are producing oil. And for frackers, $15 a day will cover it. But what they won't pay is the debt. So what happens? Last year, over 25 companies in the U.S. defaulted on their debts. They didn't make their full or any debt payments. And my guess there'll be many more of those this year. There were two companies that filed for Chapter 11. Now, we went through this whole thing with the homeowners. Remember that? How can you forget that? And homeowners, when they stop making payments, the bank starts a foreclosure, and it's a fairly rapid process. You can't file for a bankruptcy and slow that process down, but companies can file Chapter 11 bankruptcy. And how that works is they'll file for Chapter 11, and it goes to a trustee. And the trustee will form a creditors committee who wants to see everything taken care of right away, and the company. And the company will come back with an operating plan to say, this is how we're going to pay everybody off. And then there's a negotiation that goes on between the trustee and the creditor committee and the company presenting it, and it's a process that can last for a couple of years. There's things that can be done, even if the creditors don't agree to this plan. And trustees have, in my opinion, more power than the President of the United States. Trustee can say, if there's somebody that was subletting offices from me, and they file for Chapter 11, and they come to the court with a plan, and part of their plan is we don't want to pay rent for that office for a year or 2 years, the trustee can say, I agree to that, and you don't get rent for a year or two. It gets delayed. Even though you have the ownership of that. A trustee can do that. They can decide that banks and bondholders need to wait. They can say, we think prices are going to go up, but you just have to wait a year or 2 years or 5 years or whatever it could be. But that process is going to take a couple of years. And in the meantime, those companies are pumping oil and selling oil into the market. They're covering their day-to-day cost. So it's not going to turn and change until the global demand reaches the overcapacity. Until it consumes that extra, we're not going to see oil prices really lift. And as we do that, what we're seeing is the Saudis are dumping stocks and bonds. Russia's running out of capital reserves. Other nations are building that. It's from a large perspective. And you look at the positives. The positives are in the consumer stocks. The positives are in the areas where lower commodity and oil prices are a positive. And that's putting money into consumer pockets. But at the same time, if you look at international stocks, and if you've listened to the program very long, you know that my concept of international is buying domestic companies which have international operations. I don't do emerging markets. I don't do international stocks. But if you look at where we are on international stocks, the Nikkei Japan is down 20%. The London FTSE is down 20%. The France CAC is down 20%. The Chinese market is down 40%. The all-world markets are down 20%. The U.S. market down 10%. We're doing better. And we're in a process where, as the tide goes out, you see who's swimming naked. We're going to see advisors and market strategists who have been investing in the wrong place take their lumps. It's a matter of being in the right place at the right time. Financial markets, the banks are going to be hurt, but it's not going to be like the home situation, because when we went through the subprime mortgage in the 2008 banks, 30% of their loans were related to housing. Today, 6% are related to oil and energy. They're going to have a struggle time, but it's not going to be like it was during 2008. Capital goods, some are going to, that are focused on mining and materials and oil, are slowing down, but others are speeding up. It's being at the right place at the right time. You know, I'm going to come back to this whole concept next week. There's just so much to cover. I'm going to talk about the kids market. I may get into Madoff. I may get into an R.W. Baird study that was done some years ago. There's a lot of things to talk about during this period of time. But for now, have a good week. You can add us at About Twitter. You can check our website and the blogs. And you can like us on Facebook. And have a great week. Listen to some of the podcast or iTunes on some of the previous programs. Till next Friday, have a great week.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you want Mike to evaluate your own portfolio, click on Add